Last weekend, President Trump tweeted the idea of creating a 50-year mortgage as a way to help lower payments for people who wants to own a house. And I know I'm going to get some pushback about what I'm going to say. But to me, it's obvious. A 50-year mortgage is an absolute disaster waiting to happen. No one should ever consider that option. In fact, a 50-year mortgage is completely unconquered territory. And if one thing goes wrong, it could crash both the housing market and the borrower. Let's talk about the actual math behind getting a 50-year mortgage in case, if ever, it makes sense. And my thought as someone who has been interested in real estate for some time now. Most people have a very little understanding on how this works and why this is such a bad idea. And before we get into that, I would really appreciate you hitting the like button, subscribe, and hit the notification bell. It will really help the algorithm push my video to more people. Thank you for doing that. To start, let's go back to where it all began, the 30-year mortgage. For those unaware, it was initially created in the 1940s as a way to finance new homes after World War II. And by the end of the 1950s, it was adopted across the entire market to encourage families to buy long-term equity. Today, over 90% of buyers choose a 30-year term on their mortgage. Of course, there are other options like the adjustable rate mortgages, the interest only loans, the 15-year mortgages, and more. But the 30-year mortgage is seen as the safest. It offers flexibility, stability, and fixed payments, and it's easy to qualify for since almost every bank offers it. However, there is a catch. Interest payment on a fixed rate mortgage are front loaded. That simply means that at the beginning, most of your monthly payments goes towards interest rather than principal because your loan balance is still high. And over time, as you pay down the loan, more of your payment goes towards your principal, helping you build what is called the equity. A chart or a picture of this looks shocking. Early on, almost all your payments are interest, but by year 20, most goes toward your equity. Now, here's where it gets interesting. The typical homeowner only keeps their home for about 12.3 years. On a 30-year loan at 6% interest, they have barely paid down any of their mortgage by the time they sell and start over. Even if they kept the house for the full 30 years, they will have paid 1.2 million for a $600,000 house. So why not a 15-year mortgage? Well, those monthly payments are significantly higher. For example, on a $500,000 house with a 6% interest and 20% down, a 30-year loan costs about $2,400 a month. A 15-year loan jumps to $3,300 a month. That means you will need an income of about $10,000 a month to qualify instead of $7,500 a month. And naturally, most people choose the cheapest option because it helps them qualify for a bigger home and a higher price point, up to 34% or more. Now, here's where the confusion starts. People will think, if a 30-year mortgage saves me money compared to a 15-year one, a 50-year mortgage must be even better. But that's where they are 100% wrong. Over the weekend, President Trump tweeted a picture of President Roosevelt, who helped standardize the 30-year mortgage alongside himself promoting the 50-year idea. My first reaction was, why on earth will this ever be a good idea? It makes zero mathematically sense, yet surprisingly, people are excited. With 12-year car loans and buy now, pay later on everyday stuff, something extending mortgages to 50 years is the next step to make housing affordable. Even major developers like Paul T. Group have endorsed that idea. But let's break down the math. Going from a 15-year to a 30-year loan improves affordability by 34%. Going from a 30 to a 50 years, less than 8%. That's it. You would barely save anything every month, yet you will be locked into debt for your entire life. For example, a 500,000 loan at 6% for 30 years costs about $3,000 per month. A 50-year loan at 7%, likely higher interest rate because lenders charge more for longer terms, will be about $3,080 per month. That's not a discount. That's actually more expensive. Even if we unrealistically assume the same 6% rate, your payment only drops to about $2,632. That's just a 10% savings in exchange for 20 extra years of debt. There is also the problem of equity. With a 50-year loan, nearly all your payment for the first 10 years go towards interest. So if you buy a $550,000 home with a 10% down and sell 12 years later, you will have paid just $32,000 on your principal. After considering the closing costs you paid at the beginning, you will likely lose money. Even if your home didn't lose in value, one small dip in the market and you are underwater. From the lender's side, it's also a nightmare. Mortgage rates are tied to the 10-year treasury yield because most loans are repaid or refinanced within that time frame. And a 50-year loan will tie up capital for half a century, far beyond the normal market horizon. Banks will not want it, investors will not buy it, and if rates fell, borrowers will refinance anyway, leaving banks with long-term losses. And beyond the math, there is the law. By regulation, a qualified mortgage cannot exceed 30 years. Those protections make loans safer for both the lender and the borrower. A 50-year term will fall into the non-qualified category, carrying higher interest, higher risk, and no federal protection. So even if this idea ever took off, it will likely be a niche product for developers to inflate prices. It won't be a mainstream affordability fix. If it somehow did pass, it might be designed for inheritance. Parents taking a loan their children keep paying into their old age, and maybe their grandchildren finish it off a century later, which frankly sound insane. At the end, a 50-year mortgage is tricky. It sounds appealing, but it's mathematically useless and economically dangerous. And if we really want to make housing affordable, the solution is no longer debt. It's actually more inventory and reducing the interests that are front loaded. And that could happen by increasing the capital gain exclusion from $500,000 to $1 million for married couple, adjusted for inflation, or allowing homeowner to transfer their existing low rate mortgage to new home when they move, or just raising the deductible mortgage interest cap to 1.5 million for new loans after 2026. This will actually encourage more people to sell, to move, and free up more homes, unlike a 50-year mortgage that just traps people longer. So, to make it very simple, a 50-year mortgage is a very dumb idea. It doesn't work mathematically, economically, or legally. It will not improve affordability. it will extend debt lifetimes, and it will probably destabilize the market. If people start signing for the 50-year loans, we've got a problem. After all, the average home buyer is 40, which means they will be paying it off until they are 90. Thank you for watching. So please like, comment, tell me what you think about this current situation and if ever this policy is passed.